Hello and welcome to Accounting Homework. Today we will learn accounting basics, a guide to almost everything. I'm Elena and I'm an accounting tutor and expert. In this video, I will teach you the fundamental concepts and principles of accounting that you need to know to understand and prepare financial statements. Whether you are a student, a business owner, or just curious about accounting, this video is for you. By the end of this video, you will learn: what is accounting and why is it important? What is the accounting equation and how does it work? What is the accounting cycle and what are the steps involved? What are the financial statements and what do they show? What is the double entry system and how does it ensure accuracy and completeness? So grab your pen and paper and get ready to learn accounting basics in a simple and fun way. Start with topic 1. What is accounting and why is it important? Accounting is the language of business. It is the process of recording, summarizing, analyzing, and communicating financial information about a business or an organization. Accounting helps us to measure and evaluate the performance, profitability, and financial position of a business or an organization. It also helps us to make informed decisions and plan for the future. Accounting is based on a set of rules and standards that ensure consistency, comparability, and reliability of financial information. These rules and standards are called Generally Accepted Accounting Principles, GAAP, in the US, and International Financial Reporting Standards, IFRS, in most other countries. Accounting can be divided into two main branches: financial accounting and managerial accounting. Financial accounting focuses on providing financial information to external users, such as investors, creditors, regulators, and the public. Managerial accounting focuses on providing financial information to internal users, such as managers, employees, and owners. Hope our to-the-point guidance on accounting help you to understand. Now let's learn quickly about topic 2. What is the accounting equation and how does it work? The accounting equation is the foundation of accounting. It states that the total assets of a business or an organization are equal to the total liabilities and the total equity. In other words, the resources owned by a business or an organization are equal to the claims against those resources by the creditors and the owners. The accounting equation can be written as assets equals liabilities plus equity. Assets are the economic resources that a business or an organization owns or controls, and that can provide future benefits. Examples of assets are cash, inventory, accounts receivable, land, buildings, equipment, etc. Liabilities are the obligations that a business or an organization owes to others, and that must be paid or settled in the future. Examples of liabilities are accounts payable, notes payable, wages payable, taxes payable, etc. Equity is the residual interest that the owners have in the assets of a business or an organization after deducting the liabilities. Equity represents the owner's investment and claim on the net assets of a business or an organization. Equity can be divided into two components: contributed capital and retained earnings. Contributed capital is the amount of money or other assets that the owners have invested in the business or the organization. Retained earnings is the amount of accumulated net income that the business or the organization has earned and retained over time, after paying dividends to the owners. The accounting equation can be expanded to show the components of equity as follows: assets equals liabilities plus contributed capital plus retained earnings. The accounting equation must always be balanced, meaning that the total assets must always equal the total liabilities and the total equity. This is because every transaction that a business or an organization makes affects the accounting equation in some way. For example, if a business buys inventory on credit, it increases both its assets, inventory, and its liabilities, accounts payable, by the same amount, keeping the accounting equation balanced. If a business sells goods for cash, it increases both its assets, cash, and its equity, retained earnings, by the same amount, keeping the accounting equation balanced. Now if I ask, do you know something about accounting cycle? No? Don't worry viewer, today we will also talk on this topic. Our third topic is about what is the accounting cycle and what are the steps involved. The accounting cycle is the process of recording, summarizing, and reporting the financial transactions of a business or an organization in a given period, usually a year, a quarter, or a month. The accounting cycle consists of the following steps. Identify and analyze the transactions. This involves examining the source documents, such as invoices, receipts, contracts, etc., and determining their effects on the accounting equation. Record the transactions in the journal. This involves making a chronological record of the transactions in the journal, using the double entry system. A journal entry consists of the date, the accounts, and the amounts involved in each transaction, as well as a brief explanation. Post the journal entries to the ledger. This involves transferring the journal entries to the ledger, which is a book or a file that contains all the accounts of a business or an organization. A ledger account shows the balance and the changes in each account for a given period. Prepare the trial balance. This involves listing all the ledger accounts and their balances at the end of the period, and checking that the total debits equal the total credits. A trial balance is a tool to verify the accuracy and completeness of the recording process, and to locate and correct any errors. Adjust the accounts. This involves making adjustments to the accounts to reflect the accrual basis of accounting, which means that revenues are recognized when earned and expenses are recognized when incurred, regardless of when cash is received or paid. Adjustments are needed to account for items such as prepaid expenses, unearned revenues, accrued expenses, accrued revenues, depreciation, etc. Adjustments are recorded in the journal and posted to the ledger, and a new trial balance is prepared. Prepare the financial statements. This involves using the adjusted trial balance to prepare the financial statements, which are the main products of the accounting cycle. The financial statements include the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. The financial statements provide useful information about the performance, profitability, and financial position of a business or an organization to the external and internal users. Close the accounts. This involves closing the temporary accounts, such as revenues, expenses, and dividends, to the permanent account, which is retained earnings. Closing the accounts means transferring the balances of the temporary accounts to the retained earnings account, and resetting the temporary accounts to zero for the next period. Closing the accounts is recorded in the journal and posted to the ledger, and a post-closing trial balance is prepared. Reverse the entries. This is an optional step that involves reversing some of the adjusting entries made in the previous period, to simplify the recording of transactions in the current period. Reversing the entries is recorded in the journal and posted to the ledger at the beginning of the current period. Now let's discuss about fourth topic, what are the financial statements and what do they show? The financial statements are the main products of the accounting cycle. They are the formal reports that summarize the financial activities and position of a business or an organization for a given period. The financial statements include the following. The income statement. This shows the revenues, expenses, and net income or loss of a business or an organization for a given period. The income statement measures the performance and profitability of a business or an organization, and answers the question, how much did the business or the organization earn or lose during the period? The statement of retained earnings. This shows the changes in the retained earnings of a business or an organization for a given period. The statement of retained earnings links the income statement and the balance sheet, and shows how the net income or loss and the dividends affect the retained earnings. The statement of retained earnings answers the question, how much of the earnings did the business or the organization keep or distribute during the period? The balance sheet. This shows the assets, liabilities, and equity of a business or an organization at a given point in time, usually at the end of the period. The balance sheet reflects the accounting equation, and measures the financial position and solvency of a business or an organization. The balance sheet answers the question, what does the business or the organization own and owe at a given date? The statement of cash flows. This shows the sources and uses of cash by a business or an organization for a given period. The statement of cash flows classifies the cash flows into three categories: operating, investing, and financing. The statement of cash flows measures the liquidity and cash management of a business or an organization, and answers the question, how did the business or the organization generate and spend cash during the period? Now today our fifth and last topic is what is the double entry system and how does it ensure accuracy and completeness? The double entry system is the method of recording transactions in the journal and the ledger, using the accounting equation as the basis. The double entry system requires that every transaction affects at least two accounts and that the total debits equal the total credits. A debit is an entry that increases an asset or an expense account or decreases a liability, an equity, or a revenue account. A credit is an entry that decreases an asset or an expense account or increases a liability, an equity, or a revenue account. The double entry system ensures the accuracy and completeness of the accounting records because it allows for the verification of the accounting equation and the trial balance at any point in time, provides a clear and consistent record of the effects of each transaction on the accounts and the financial statements, enables the detection and correction of errors and frauds by creating an audit trail and a system of checks and balances, facilitates the preparation of the financial statements and the analysis of the financial information. I hope you enjoy this informative video on accounting basics. If you have any questions or feedback, please let me know. Please subscribe to our accounting homework channel to gain continuous accounting knowledge.